You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributor to Backroom Technician. This week on the Biz Disability Insurance for Individuals series and our tribute to disability awareness for the month of May 2013. And on today's show, Marketing Disability Insurance with Marcy Pruitt.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. Welcome, happy Friday to us, right? And we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, a suburb of Phoenix, Arizona, home of America's largest fountain. And I want to welcome back day 5, the diva of all disability, Marcy Pruitt. Hey, Marcy.
Thank you, Steve. Hi.
Well, we did kind of touch a little on marketing, on short term, how do I position my contract, but we really didn't get into it like I want to get into it on this show. Now, when we talk about DI, people say, Steve, I'm sorry, I do life insurance, I do annuities. And I'm forced to do LTC and I don't like it because we have a lot of mortality agents. But now that people are coming out of Obamacare, I think you need to wake up to this because you're going to have some competition and they're coming through the morbidity wing on this. And they're looking at DI because it has some similar issues with medical underwriting. Right. They're looking at DI. So you need to wake up on this because people that are leaving the medical field to come in through mortality versus long-term care, with long-term care and disability are looking at this. And we want you to be prepared because competition can be coming. Right now, there isn't any. Really, you should be walking in there. This would be distinct for you. Now, when we're talking about marketing, I'm looking, and I have every one of these, Marcy and DI Dan, who's going to be with us next week on all that is business disability. We're going to be giving away any of these sales strategies. They have so many, and we're happy to give them away. Just write us at thebiz.tv. And while you're out there, if you've missed any of our shows, Monday through Thursday, you need to watch all the shows I recommend for a learning experience, in order and in chronology, so that you can really get the idea of what Marcy and I are talking about. Now, Marcy, let's just get into it, because, I mean, you have these are pages. I mean, we got a ton to talk about. I don't understand, because I thought ONAC was the way to go, right? Every time I bring up ONAC, it's very specific, it's high-end, white-collar. But you say avoid the ONAC oversell. Talk about that.
Well, we talked about ONAC a little before with the 4 tiers of own occupation. And unless you're highly specialized and a trial attorney, a litigator, a specialized physician, it could be an oversell. Because think about it, what is an executive going to go do that's completely different, that doesn't use their skill set in administration and talking on the phone, driving, consulting, everything, your daily duties as an executive. So a modified ONAC, which can be anywhere from 10 to 30% less expensive, serves the masses. I mean, it's a good, solid policy.
So you don't recommend bringing this up. You think it's been an oversell, it's been a problem.
Well, and it has been, and in the industry, which has been very cyclical, there were times when carriers removed the ability for physicians to buy the ONAC. I mean, so because it was overused and oversold, and with the consolidation of the industry, and now carriers, the players that are left, they're very aggressive, and we're seeing it come back in very favorable again.
Well, no, we talk about non-can all the time. I want a policy that's non-cancelable, they can't raise my rates, all those things, all those golden things that consumers want. And I think that's a great thing to have. But what about the you call it eliminating the non-can nonsense. By the way, I have to say, kudos to that marketing. I love that pitch.
That's DI Dan.
That's DI Dan. Thank you, Dan. We'll talk to him next week. Non-can nonsense. He says eliminate that. What does he mean by that?
Well, again, we all were trained to sell non-cancelable policies, and because that means the premium will never increase. It doesn't mean, not only does it mean it cannot be canceled, but more importantly, the premium cannot increase. A guaranteed renewable policy, it cannot be canceled, but the premium can increase. And however, historically, we have seen carriers file a new product and sell higher premiums with language differences and whatnot, contractual provisions changes to new consumers. The book in force, if it's a guaranteed renewable product, the carrier would actually have to file rates with the state for everyone in that occupational rating and prove loss ratios, and that's really never happened. So to look at a contract where you can save as much as 30% by using a guaranteed renewable definition, it makes perfect sense. Now, that's, historically we haven't seen price increases. A very young professional getting into a policy today, I would probably still do non-can. But an individual female, for example, in their 50s, with sex distinct rates, that would be very expensive. You might want to consider a guaranteed renewable version.
Okay, so the difference between non-can and that price tag of guaranteed renewable version, what's the spread on that, like on your 50-year-old female?
Well, it can, and again, it depends on your occupation. Sure. And using the female 50-year-old example, that could be about 20%. I mean,
so it's different. It's
yeah,
a difference.
It can be as much as 30% in certain ages, and males probably more so.
Okay, so but you're really saying a lot of times this gets in the way. So stop the non-can nonsense. Really,
right?
That's really what you're saying. Well, when I think about this, I'm looking at different ways to present DI. Now, one of the ones I used yesterday was I took the human value, I took the cost, and I said, listen, I'm looking at this 50-something male, and I looked at the rest of his earning life, and he was somewhere around 1.9 to 2.1 million dollars he's going to earn over the next 8 and 9 years or whatever it was. I look at that number and I say, I'm paying 2.5% to protect $2.1 million of the earning for my potential. Sometimes when we frame it, he who frames the argument, he who frames the sales strategy wins the close. So I'm looking at this and looking at numbers. When we come back, I want to talk about this idea. It's a great sales strategy. You guys have you have several here. I mean, I only picked the 7. They have 7 of them. But when I look at this, I want to look at the present highest benefit versus the lowest cost. And I think there's a trap we fall in as salespeople. We don't think clearly. You guys do DI 24/7. Well, maybe not 24/7, but pretty much you're thinking about it all the time. And I want to talk about that when we come back from the break, because I think this is the right way to sell DI. We're talking about marketing all this whole segment. So when we come back, we're going to talk about this, because this is sales strategy number 1. Absolutely. So when we're back from the break, we're going to continue our talk about marketing disability insurance, part of our disability insurance series with Marcy Pruitt. And don't forget to enroll in IULUniversity.com for the best training, education, sales support when it comes to life insurance.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Marcy Pruitt. And remember, you can order today's materials at thebiz.tv. And while you're out there, click on the background technician icon that's on the Biz blog page for your free 30-day trial on the best needs analysis and sales support materials. I think there's like 720 reports out there. I've been using it for 22 years, and for $50 a month, once you decide to buy it, it is to die for. It'll pay for itself easily on your first sale with a client, because I got to tell you, everybody's using it. Many of the BDs use it now. And speaking of BDs, before you move forward with anything you hear in our show, always consult your broker, dealer, compliance officer. And of course, we talk about taxes, which we talked a little bit about tax deduction. We're going to talk about it next week with DI Dan like crazy. We're going to talk about all things deductible. Don't forget to talk to your tax consultant before you move forward. We're talking about DI and how to market it. Marcy Pruitt, one of the most top of the line, nationally recognized DI experts in the country. I'm looking at the mistake that Steve Savant has made over his career. A little confession time. I've been selling DI in the wrong way, according to Marcy Pruitt. I've been selling it like this. Why would you spend $2,499 for a chance for a $5,000 benefit? I think I've been doing that all day long. I've been saying, there's my price tag, there's my benefit. 2 to 1 does not sound like leverage.
Absolutely.
I've been making a major mistake. Correct me.
Okay. Well, and most agents sell the wrong way. They sell the the highest, highest annual premium for the monthly benefit. And every illustration you ever see will have the potential to age 65 or 7 out there. So the examples we used before, where we talked about your earning potential, if somebody was on track to earn $1.9 million with their human value calculator, then you want to sell that potential benefit, which is right on your illustration, your earning potential of $1.1 million, and break down that $2,500 annual premium by a daily cost. So for $6 a day, for example, you potentially can be paid $1.9 million of benefit.
I think sometimes you have to break it out. I think sometimes bite-sized, chewable premium may be better than how we think about it. So if I took your example, I have a $5,000 benefit, and I multiply that times 32 years to the end of the benefit period, I'm looking at $1.9 million total free, and I take my premium, I divide that by 365 days, and I'm paying, listen, $6.71 a day to protect that big number of $1.9 million.
Exactly. And even more importantly, to take that a step further, when all the other things we insure, our homes, our cars, look at the cost per day that you're spending for that. And invariably, the cost to protect your income will be less than the combination of all the other insurances that you're paying for.
I'm looking at their sales strategy too, and this is this yin and yang. I mean, I can't tell you how many carriers on the mortality side are now adding morbidity riders like catastrophic care and DI. But I noticed that you have this double bookend protection idea. Talk about the protection, double bookend protection with critical illness and retirement protection. That was the shocker to me.
Right. Well, most disability policies on a long-term basis have like a 90-day wait payable to 65. Well, think of that, the deductible, the 90 days. If you have a critical illness policy, as soon as you're diagnosed with the cancer or kidney failure or stroke, whatever, one of them, there's 12 to 18 major critical illnesses, you receive that lump sum of money. So on the front end, you get your lump sum of money. Then you have your disability policy payable to expiration, which is typically age 67. And there's a retirement benefit that can kick in. So if you insure your retirement benefit, that will then kick in as a lump sum or a payment on the back end.
Okay. I'm just trying to be the normal person watching this show, and I'm saying I get the catastrophic, I get that. I think everybody's there. But you just said, so if I'm putting away a couple grand, a month into my 401k or my other retirement plan, I can insure the entire contribution.
The contribution
against
plus employer.
Disability.
Right. The employer match as well. And so you set up a separate policy, and that money goes into it. When you become disabled, that money would go into a trust. So you're essentially continuing to fund your nest egg. Because what happens when you're totally disabled? Your contribution stops. Most Americans take hardship and cash it out.
So that's going to be in addition. So if I have a long-term DI, that's one policy.
Right.
But they're going to look at this as a standalone income issue for retirement.
Correct.
Oh wow!
So it's a lifetime stream of income. Your DI runs out, and now you have your retirement.
So I know we got age issues and so forth, but basically, are people looking at this now?
Absolutely. It's where we see people looking at it is when they've exceeded the max. So for certain occupations, $10,000, $15,000, $20,000 is the maximum traditional amount of disability coverage you can purchase. So the retirement, if you're putting another $49,000 away in a in a pension type qualified contribution plan, then you can insure that as well on top of your other disability.
So sometimes when you guys hit the ceiling or the cap limits on a big player, we haven't even addressed his money that he's putting aside before tax dollars into his qualified plan or whatever. Man, I think that'd be huge. Now, does it have to be a qualified plan, or could it be non-qualified life insurance, as an example?
Well, it's a qualified contribution plan. Defined benefit would be exceptional with the track record, but typically some, 401k, SEP, IRA, KEO, that type of program.
Wow, I think this is a huge adjunct to this, because I think people see themselves living longer.
Right.
And if they got disabled and weren't able to put their contribution aside, they would be short. And we're already talking in America, by the way. We're short already. Some of you will live to 100.
Absolutely.
Every day, Willard Scott says happy birthday to people that are turning 100, and a lot of our baby boom female gals are going to see that date. Remember, you can watch all our DI shows this week by hopping out to our site at thebiz.tv. And don't forget to follow me on Twitter, Facebook, LinkedIn, Pinterest, and Google+. That's the Buzz on the Biz for today. You've been in the zone, the Business Insurance Zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.